Hello, this is Stacy Francis, and I'm so excited to be here to talk about the important things you need to know to get in charge of your finances, to know how to make savvy decisions, and actually have peace of mind with your life. Today, we're going to be talking about the financial education essentials. And I have to tell you, they're the building blocks of feeling smart and actually being able to make those good decisions about your money. We're going to be going through a lot of information. So with that, please get out your pen, your paper, and know that this is recorded. So you can always come back to review it again, particularly if there's an area that we might be moving too fast or that you just want to review. So without further ado, let's get started. We've got a lot of information to go through, and I'm going to try and make this as user-friendly and easy as possible. So we're going to try and get through this in the next 15 to 20 minutes. It's a big feat, but I think we can do it. So what is a financial planner, and what should they be doing for you? They have three main roles. The first one is helping you make a plan, creating a proper mix of investments based on your financial situation and also your goals. It's number two, helping you stick with the plan and staying invested, remembering to look to the long term. Even though we know the market goes up, it also unfortunately goes down. But sticking with the plan results in better investment performance. We have seen that time and time again, and numerous studies out there very much prove that long-term investors have much better performance than those who focus on the short term. And number three, something that's really key. Your life changes. Well, guess what? Your plan needs to change too. And that means your financial plan, your financial roadmap. But it also means that your investments may need to change in your portfolio too. Not only because you're getting older, but also your risk tolerance may change. Your goals may change. And also to continue to make sure that they're right to achieve the life you want to live. So, what is the easiest way to get savvy about investing? It's starting with the basic building blocks. And one of those building blocks is what's called a mutual fund. Well, I'm going to show you the definition of a mutual fund, which essentially it's a pool of money supplied by investors like you, pooling your money together to invest in stocks, bonds, or money market. Well, I don't know about you, but that's not necessarily the sexiest type of definition that you could really think of about a mutual fund. In fact, I have something that might make a little bit more sense to you. Have you ever pooled money with a couple of your girlfriends, maybe another family member, your mom or aunt, for a very special occasion to celebrate someone's birthday, maybe a milestone anniversary, maybe a wedding? But what's unique about pooling your money together with several other people is that you have a lot more money. So you could buy a much nicer present. In fact, you could buy many presents. And that's exactly what a mutual fund is all about. It is pooling your money to be able to buy ownership in more stocks and bonds than you could possibly do on your own. Why is that important? Well, if you have ever heard of don't put all your eggs in one basket, mutual funds help you do just that, making sure that not all your eggs are in one basket and that you have ownership and exposure to many different stocks and many different bonds. So let's talk a little bit about what's in mutual funds or exchange traded funds. It can be a stock, it can be a bond, it could be a money market security. What most of us are familiar with are stocks. And stocks, quite simply, are ownership in a company. And I know for some of you, this might be very ABC, very investing 101, but it is important to understand. It's important to understand that ownership of a company, for example, with Martha Stewart here, you own, of course, part of the magazine empire, part of the media empire with TV, but you also own any of the assets of her business. So you might own also a piece of that stove that you see she's cooking on, even some of the equipment that you see in the studio kitchen. So it's ownership, albeit a small part of the ownership, but ownership of that entire company. And there are many types of stocks. In fact, we just talked about Martha Stewart Living, but what about Facebook, Pfizer? There are many hundreds, thousands of different stocks you can own. And we can categorize them into two different buckets. The first bucket are growth stocks. And typically, you would want to buy a growth stock if you believe the price of that stock is going to grow. A good example, Google. I don't think anyone would say that Google's cheap right now as far as the price it's trading at. But the reason you would want to buy it is you expect it to even go up further in value because the company is growing so quickly, so rapidly. Now, value stocks, they have a different bucket. And those investors buying value stocks, they're doing it for a different reason. Trust me, they want to make money too. But they're buying potentially GE, for example, because they believe GE is undervalued, that it's going to go up in value because the price it's trading at right now is below really where it should be. So you're making money or hoping to make money from these two different buckets, value versus growth. But typically, you're approaching it from a different aspect. So why do we even care about even categorizing whether a stock's growth or a stock's a value-oriented stock? It may not seem really important, but what we have historically noticed is that growth stocks and value stocks perform differently in different economic environments. So you really want to have both. That is part of having a diversified portfolio. There's even another way that you can categorize stocks. You can categorize them as small company stocks, mid-sized company stocks, or large company stocks. Large company stocks, definitely you have heard of many of those, Coca-Cola being one of them. Small company stocks might be stocks you haven't really heard of before. They might not have been around so long. And what's important about all three categories, large, medium, and small, is that they have different characteristics. And having a little bit of each, again, adds to that diversified portfolio. Now, I have to tell you, one of these out of the three is the most risky, has the most risk associated with it. What do you think? Do you think large company stocks have more risk associated or small? You're right, small company stocks do. Small company stocks have much more risk associated with them because they haven't been around as long. They may not have as many business lines of credit where they can dip into those lines of credit to help them in bad times. They may not have as much cash on hand and in reserves. Could be that their product lines are fewer and could be more impacted by a negative downturn in the market. But we also see that over time, small company stocks grow faster than large company stocks. So even though there's additional risk with small company stocks, you are being rewarded by higher growth. So if you have a portfolio, should you just put the majority of your ownership of stocks in small company stocks because you know they're going to grow faster over time? The answer is most likely not. You want to have the largest share of your stocks be really highly rated, well-known, highly respected, financially stable, large company stocks. And the engine of that portfolio can be some small company stocks in a smaller percentage. So how do you make money? How do you make money? Well, I hope you don't look at me and judge me, but I'm going to tell you something. My guilty pleasure is I love to drink Diet Coke. And I know I've read the rat stories where the rats die. I know that there's so much sugar in them. But I would say once every 2 weeks, I splurge and I have a Diet Coke. So that's why I chose Coke, because I'll be honest, I really love Coca-Cola, and that's my guilty pleasure. So in this case, I bought Coke back on June 8th, and I bought it for a little over $40. $40.16. I then decided to sell June 8th, 2016. What's interesting is that I made what's called capital gains. And you can see that I earned well over $5 a share, which is pretty darn phenomenal. So what do I have to do? Do I have to pay short-term gains or do I have to pay long-term gains? Well, it's long-term gains. So depending on our tax rate, it'll be anywhere from 15 to 20% of our taxes. In fact, there are additional taxes such as the Medicare surtax that some people also will have to pay on top of that. If I held it for less than a year, I have even a higher tax rate that I have to pay on that $5 of gains. I have to pay taxes on it as if that $5 came to me in my paycheck. So yes, it includes federal tax and state tax. And if you live in New York City like I do, local tax, Social Security, and Medicare. In fact, from that $5 of earnings, I might only be walking away with $3. Or if I'm lucky, maybe $3.25. It can take a really big tax bite. So when you earn money on your investments, it's very important that you have what's called long-term gains of holding it a year or longer so that you are taxed at that lower rate. Very, very important. So what about dividends? There are some stocks that pay dividends. And actually, interestingly enough, the company I like, my Diet Coke, they pay dividends as well. In fact, back in July this year, they paid a dividend of 71 cents per share. So that meant that for every share that I owned, which I'll mention, let's say I own 10 shares, I get 71 cents. So in total, 10 times 71 cents, I had $7.10 in dividends. Well, am I lucky? Do I get to keep that without having to pay taxes? No, I definitely do not. And in fact, I need to pay taxes on dividends as well. So dividends are paid out from stocks, but you unfortunately have to pay taxes on it as well. What type of companies actually pay out dividends? Remember how we talked about the growth-oriented versus the value-oriented? The companies that tend to pay out dividends are those that are value-oriented. So very interesting, again, another way that you can make money by investing in the stock market. First is by capital gains. That means the price of the stock goes up. But dividends are paid out to you by just owning the stock. And with that, potentially having a tax liability. What's interesting is that you typically would pay taxes on this close to that 15 to 20% rate that we talked about before. And again, it's going to be depending on your tax bracket. So let's talk a little bit about a bond. A bond is merely a loan. And so in this case, Pfizer is taking out a loan, and you are giving them the money. So this is a lovely woman here who is essentially buying a loan, buying a bond from Pfizer. So she's going to give Pfizer, let's say, $5,000. She's not doing it out of the kindness of her heart. In fact, she's going to expect interest, something to compensate her until finally the principal or the dollar amount that she gave them, that $5,000, is finally paid back to her. That's what a loan is all about. That's what a bond is all about. Essentially, a bond is buying a loan. So who can you buy bonds from? Or loans, whatever you want to call them. The government. I'm sure you've heard of government bonds from municipalities like New York MTA, for example, municipalities, municipal bonds, and private companies called corporate bonds. You can buy bonds from Goldman Sachs, bonds from Pfizer. These are all different places where you can purchase bonds from. And bonds have different maturities. And maturity is exactly what it sounds like. It's when the bond matures. It's when you get your money back that you originally paid out for that bond. So a short-term maturity means that in the next 5 years, that bond is going to pay you back the original money that you put in. What's considered an immediate term bond, an intermediate term is receiving your money back in anywhere between a 5 to 10 year window. And long maturity is not getting your money back. That window is 10 years or beyond. Now, as you see on the slide, the longer maturities pay higher interest. Whereas those bonds with shorter maturities, when you get your money back a little sooner, they tend to pay lower interest. Well, why would that be? Why would that be? Well, it's because we find that longer term bonds, longer maturities, have higher risk. A lot can happen, and I think a perfect example is Ford. Who would have ever imagined back in the 80s or even the 90s that Ford would find themselves on the verge of bankruptcy and finding themselves in such financial straits? Those long-term bondholders, you bet they were pretty surprised too. And they had held on to those Ford bonds and had a very big negative surprise. But what if you had bought a bond that was a 5-year maturity back in the 90s? Well, before Ford ever found itself in any type of financial trouble, you'd have your money back. It's not as much risk. And that's why maturity is important. Because a maturity, again, is that given amount of time until the issuer, in this place we talked about Ford, pays you back the amount you borrowed. Other things we want to think about, not only maturity, but credit quality. Is this a very financially stable company, like a Goldman Sachs? Or is this a company that might be teetering on the brink of bankruptcy? That's important and definitely should inform your decision of which bond you buy. And so is it low credit quality, such as that one that I talked about that is teetering on the edge of bankruptcy? Well, if that's true, you're going to demand a higher interest rate. You're going to demand, you better pay me some more interest. I'm taking on a whole lot more risk. However, if it's very high credit quality, like a Goldman Sachs or a treasury from the U.S. government, you're going to be paid most likely lower interest because you're not taking on as much risk. This is a wonderful chart, the Standard & Poor's as well as Moody's, and it shows you those different credit qualities being high grade all the way down to speculative and default. And knowing that those high grades, you're going to have a lower interest rate, most likely lower earnings. And as you get further down the spectrum to the lower credit qualities of speculative, high yield, default, that there you're going to make a whole lot more money, but there's a whole lot more risk. And you can also lose there too. You can see great gains from those types of bonds because of the credit quality and the risk. You can also lose money there as well. So how do you make money in bonds? Now remember, when we went back to stocks, we have two ways we can make money. It's through the gain, the price of the stock going up, and what's called capital gain, or the stock paying out a dividend, income. For bonds, you can make money by the fact that the bond will pay you income. And some bonds also can go up in value, which is that capital gain. But it's not so clear about how the income is taxed, because some bonds you don't actually have to pay taxes on, such as municipal bonds. Any interest that you're paid, you don't have to pay any taxes on it. Tax deferred means that you don't have to pay taxes on it to a date in the future. And taxable, well, taxable means that you have to pay taxes on any interest you receive, not tomorrow, but yes, today. So which one would you want to choose? If you had the choice between a bond that you don't have to pay any taxes on the income versus a bond that is taxable, that you have to pay taxes right now, which one do you choose? You're going to hate my answer, but the answer is it depends. If you are in a high tax bracket because you're earning a lot of income from your job, from your employment, maybe from maintenance or alimony, if you're in a high tax bracket, you might want to go for municipal bonds because the benefit of not having to pay taxes on every dollar earned means a whole lot more for you. If you're in a very low tax bracket, then I would say you might want to be thinking about a taxable bond, such as from Goldman Sachs. Yes, you're going to have to pay taxes on that interest, but because that interest is taxable, those corporate bonds pay you a higher interest rate. So know that municipal bonds, yes, you don't have to pay taxes on the interest, but you bet that the interest rate they're paying you is going to be lower, right? You're getting a huge benefit. They don't have to pay as high an interest rate. But taxable bonds, they're going to pay a higher interest rate to you. But unfortunately, again, you're going to have to remember to pay taxes. And if you're not sure, I know this is a lot of information. If you're not sure, again, you want to talk to your financial advisor. You want to talk to your accountant. And what's a money market security? It's a fancy way of saying it's essentially cash. It's essentially cash, and they're ultra short-term bonds, so it's relatively safe. A safe place to often park your emergency fund, a safe place that you might need cash for the next 6 months, 12 months, or so. So what are the benefits of mutual funds or exchange-traded funds? Both of them, remember, are merely baskets. And in that basket, you can choose different types of stocks that are in there and different types of bonds. One of the biggest benefits is you are able to have diversification. Even with investing as little as $5,000, you can buy a wonderful mutual fund that mixes a beautiful blend of stocks and bonds for a gorgeous portfolio for you with $5,000. If you were to try and buy individual stocks and individual bonds, to do that, you would be hard-pressed. It would be very difficult. The other piece is that there's professional management. You're not alone. The majority of these mutual funds have professional managers that are buying and selling and making smart decisions about what stocks to buy, what stocks to sell, what bonds to buy, what bonds to sell. Convenience. They're very easy. You can get your money tomorrow. Easily able to liquidate and have your money whenever you need it. You're not locked in. Helping you create a plan and having that portfolio be allocated correctly for you is really based on three things. Now, it's number one, your goals. Number two, it's your risk tolerance. And number three, it's how much you can add to your savings and when you're going to need that, take that savings out. When we talk about what types of returns can you expect, most people are pretty excited to see, well, what's the average return for this portfolio over the last couple years or last 10 years? Well, what we did is we took a look at several different portfolios. We went all the way back to 1926 and looked at what would be the average return for a portfolio invested 100% in stocks versus one that was 50% stocks, 50% bonds, and then on the other side, 100% bonds, being more conservative. Well, you can clearly see from this chart that you would have been very happy if you were in 100% stocks. You would have had over a 10% return. You can see it's 10.2% on average each year. You would have a phenomenally large portfolio. You would have been very happy with your best one-year return. In 1 year, you actually you essentially doubled your money. It was a 54% return. But the worst, you would have seen a loss in 1 year, in 12 months, of a negative 43%. Would you be okay with that? So let's go to the other extreme. This is an ultra-conservative investor who has decided 100% in bonds. Their return is on average 5.5% each year. The best return? Not too bad, not too shabby, a 32% return. But their loss, very little. Really not much of a loss to really worry about. Only an 8% loss, as again, the worst loss in history, going all the way back to 1926. As you look across the spectrum, you see that as we add more stocks, we see what? We see the average return going up. You're compensated by taking on more of that risk. But notice that the depths of losses also trudge deeper the more stocks we take. This is really important because what this is again showing you is what type of negative returns can you handle without moving away from that goal of continuing to be a long-term smart investor. In fact, let me show you an example. This is a wonderful chart. I know there's a lot of different colors. And let me show you how you read them. So in green here, we are looking at real estate securities. This is the S&P 500. This is Russell mid-sized company stocks. These are bonds. It goes all the way down. And something that I want to show you, this being at each of these years showing you the best performance, the best performing asset class, and down here being the worst performing asset class. So let's go through, and I'm going to show you a little bit of information, which is really interesting, because overall, the highest performing asset class across all of these years were mid-sized companies, mid-sized company stocks. But look, some years they were just middle of the road. Other years not so good, even very, very poor. But look, other years doing phenomenally well. But overall, did the best. What about emerging markets? That was the second best performing. Wow, emerging markets had a really wonderful ride through till 2007, but then had massive losses. And again, you can see that volatility. What about real estate? You can see real estate also kind of a wild ride. What about the S&P 500, the 500 largest stocks trading on our exchange? Here you can see that it had kind of middle of the road. And then at the end here over 2013 and 14, really rising higher. You take a look and you can just see all these different asset classes have very differing histories. And so being able to time the market to say when one asset class is going to be the best versus another, to be honest, is just not a realistic opportunity. If you could foretell what's going to happen in the stock market, if I could foretell what's going to happen in the stock market, right now we would be both having pina coladas on the beach with our feet up in the Bahamas. Well, it just isn't so. No one can tell what's going to happen with the market on a day-to-day basis with 100% certainty. And so it's really important to have a diversified portfolio so that you have stocks and bonds and foreign stocks and U.S. stocks. Very important to be diversified. And it's also important to be able to make a difference and be able to embrace the things that you can change. So, for example, being tax efficient. Your non-retirement accounts, whatever money you make there, you have to pay taxes on. Non-retirement accounts are also called taxable accounts. And guess what? They're called taxable accounts for a reason. They're called taxable accounts because you have to pay taxes on any money you make right now. Retirement accounts, well, that's a different ball of wax whatsoever. Whatever changes you make, you don't have to pay taxes necessarily until when you take the money out in the future. Retirement accounts are often also referred to as tax-deferred accounts. Being efficient by putting investments in the right buckets to help reduce your taxes makes a lot of sense. So, for example, if you're in a high tax bracket, a very high tax bracket, in your taxable account or your non-retirement account, if you have bonds in there, you're going to probably want municipal bonds. Do you remember those municipal bonds? Those are bonds that you don't have to pay taxes on necessarily. So that's something to think about. Again, being smart about where you put your investments, that's something that you can control. And there's a lot in the market we can't control, but being tax efficient, boy, that makes a big difference. The second piece, things you can control other than being tax efficient, the second piece is investing in the lowest cost way possible. Kind of like you walk into a store. Why would you go and buy a suit on the full price rack that is 50% off in the sale rack, having everything be the same suit, the same size, the same maker, the same everything, even the same season? You wouldn't do it. Why do you do that with your investments too? Number 3, you stick with the plan. Most people, when the market's going up, is when they don't want to miss out. It's going up, it's going to a peak, and so they put more money in, money that might have been sitting in cash. And then the market might fall because that's normal. Markets go up and down. And right about here, right at the bottom, they get really frightened that maybe the market, that this is different, that it's going to be a free-for-all, that the market will never come back, and they sell and go into cash again. They repeat until broke. That's the definition, the exact opposite definition of a long-term investor. So don't turn a temporary decline into a permanent loss. And in fact, what we have seen very, very clearly is returns from investment advisors versus returns from individual investors. Not that we are necessarily any smarter, although we may have a little bit more education in the area of, obviously, finance. The big difference is what we call the behavior gap in what you see from professional investors to individual investors. And let me explain this more. Here we see a total of 7 different studies. Each of these studies looked at what is the difference in returns from individual investors versus professional investors. And what we saw is Dalbar underperforms by 4%. They said the typical average investor underperforms on an annual basis and trails by over 4%. We have some others that have 1%, 1.5, 2.1, 1.6, 3.1. And it isn't because necessarily investment advisors are choosing better investments. That can be part of that reason. But the majority of the underperformance of the average person is getting caught in that behavior gap, getting caught in the worry of the market's never going to come back up and I'm taking my money out, or putting it all in at the wrong time. It's the long-term investing that makes you a successful investor. And also, finally, adjusting the plan. So starting off with a nice mix for you, which might be 60% stocks, 40% bonds. I don't know. You might be more aggressive, maybe 80% stocks. But then, due to life changes, market movements, your portfolio can start to look a little differently. Really important that we bring it back in check to that ideal allocation, that ideal goalpost that we said that we were going to shoot for, that mixture of stocks and bonds, being able to buy low at cheap prices, selling high when the market's doing really well, to move you back to that ideal mix of stocks and bonds so that you have a diversified portfolio. Now, I know that this has been like a fire hose. I've taught a 1-hour class in the matter of about 20 minutes. So you have been phenomenally attentive. You've been phenomenally motivated. And I should just say, you should be phenomenally proud. You need to know this information. Anyone who has a dollar in their hand needs to know this information. Financial knowledge is power. Financial knowledge is freedom. Financial knowledge gives you security to make smart decisions. And this is just the beginning. It's just the beginning. And I know that this is a lot, but it's your first step. And just as the first time, if you can remember back, riding a bike, it felt so uncomfortable and very scary. And I know it probably feels that way too. But eventually riding that bike, it got comfortable, and now you jump on the bike, you don't even think about the pedaling. It just comes naturally. Finances are exactly the same. Money is exactly the same. So I want to acknowledge that you are investing in you, you're investing in your future, and please reach out if you have any questions, because we're here to support you. Thank you. Stacy Francis from Francis Financial.